Everyone loves the idea of passive income, but when it comes to actually living off dividends, the numbers get confusing fast. Most people assume they'll need millions to retire, some unreachable mountain of money that makes the whole idea feel impossible. But what if the number isn't as out of reach as it seems? What if all you need is only $10 a day? In this video, I'm cutting through the guessing game and looking at the full picture. We'll start with where most Americans are financially, then break down what SCHD is, how it works, and what kind of income it can actually produce. You'll see what it holds, how it manages itself, the risks involved, and why so many people give up before it starts working. And at the end of the video, I'll show you and Josh exactly how much you'd need to invest in SCHD to make over $5 grand a month. Whether you're planning to retire 30, 20, or even 10 years from now. But first, let's start with the financial baseline most people are working with today. In 2025, the median full-time worker in the US is earning around $1,196 a week. Multiply that out, and you're looking at just over $62,000 a year before taxes. On the household level, the median income is about $83,730. So yeah, on paper, it doesn't look too bad. But here's the problem. Costs are rising faster than wages. Rent, healthcare, food, and transportation take a bigger bite out of every paycheck year after year. By the time the bills are covered, most families have very little left over. The CEIC data shows that by the end of 2025, the average monthly earnings are around $4,900. But in many parts of the country, just paying rent and basic expenses can wipe out most of that. It's no surprise that the US savings rate has been stuck at very low levels, often below 5%. For someone earning $62,000 a year, that means saving barely $3,000 annually. That's where the problem really shows itself. Even for people in their 50s, the average 401k balance is under $100,000. It's not nearly enough to retire comfortably, and it leaves many people wondering if they'll ever be able to stop working. This is why dividend investing catches people's attention. It feels like a way to turn savings into a reliable extra income, but as we'll see, the math behind living entirely off dividends is not as easy as it first appears. Now that we've set the stage, let's talk about SCHD itself, the hallmark of dividend investing ETFs. SCHD stands for the Schwab US Dividend Equity ETF, and if ETF sounds complicated, it's really not. Just think of it like a bundle. Instead of buying one company's stock, you're buying a whole basket of them, all in one shot. So with one purchase, you get exposure to a bunch of high-quality, dividend-paying companies. Charles Schwab launched SCHD back in 2011, and since then it's gained a massive following, especially among people who want passive income without all the day-to-day drama of managing individual stocks. Here's what makes SCHD stand out. It focuses on US companies that have a strong history of paying reliable, growing dividends. Right now, SCHD pays a dividend yield of about 3.67%, which means if you invest $100,000, you'd expect around $3,670 in dividend income in a year. On top of that, it has a very low expense ratio of just 0.06%, meaning almost all of the returns go to investors instead of management fees. Another reason investors like SCHD is its simplicity. The fund pays dividends quarterly, so you get income every 3 months without having to lift a finger. It's also highly liquid, with millions of shares traded daily, making it easy to buy or sell whenever you want. But the biggest reason people like SCHD is that it has a track record. It's not some hype-fueled gamble. It's been around for over a decade, delivering steady income and solid growth, all while keeping things incredibly simple. No wild swings, no need to constantly babysit your portfolio. You just hold it and let it do its thing. That said, just knowing what SCHD isn't enough. If you really want to understand what you're getting into, you've got to look at the holdings, see how it's performed, and what kind of risks come with the ride. Let's start with performance. Over the last year, SCHD has been mostly flat, down about 0.08%. That might sound disappointing, but it reflects the broader market volatility we've seen recently. Over 5 years, the story looks much stronger. SCHD has delivered a 46.23% total return. And if you zoom out to 10 years, the return is even more impressive, about 134.44% growth. That's more than doubling your investment while also collecting dividends along the way. Speaking of dividends, SCHD currently yields about 3.67%, which is higher than the average yield of the broader S&P 500. But the real star here is dividend growth. Over the last decade, SCHD's dividends have increased at an average rate of 10.77% per year. That means not only are you getting a steady income, but that income has historically grown faster than inflation. Now let's talk about what SCHD actually owns. The fund holds 103 different companies. The top 10 holdings make up 41.31% of the total portfolio. These include big, well-known names like Chevron, PepsiCo, AbbVie, Home Depot, Cisco, and Merck. In terms of sectors, SCHD leans toward energy at about 19.83%, consumer defensive at 19.05%, and healthcare at nearly 15.74%. Technology, consumer cyclical, and financials make up most of the rest. This mix provides diversification but also concentration in a few key sectors. In just a couple of minutes, I'll show you, based on performance, dividend growth, and core holdings, exactly how much you'd need to invest in SCHD to make over $5,000 a month, whether you're planning to retire 30, 20, or even 10 years from now. But first, like any investment, SCHD isn't risk-free. One number to pay attention to is volatility, which is just a fancy way of saying how much the price can swing up or down. SCHD's annualized volatility is around 16.12%, which is about average for an equity fund. The higher the number, the more dramatic the ups and downs, so ideally, lower is better if you want a smoother ride. But with stocks, some movement is normal. Another term you'll hear is turnover rate. SCHD's is around 29%, which means roughly a third of its holdings are replaced each year. That's not too high, and it's actually a good thing here. It shows that the fund isn't just sitting still, it's actively rotating out weaker companies and bringing in stronger ones. In general, lower turnover can mean fewer taxes, but in a fund like SCHD that updates itself with a strategy, some turnover is healthy. Then there's sector concentration, which just means SCHD puts more of its money in certain industries like energy, consumer staples, and healthcare. That's great when those sectors are strong, but if they hit a rough patch, SCHD can lag behind. So even though you're getting diversification, it's not as wide as something like an S&P 500 index fund. So yeah, while SCHD checks a lot of boxes, it still moves with the market, and it has its own set of risks. That's why understanding how it keeps itself in shape year after year is so important. On the positive side, SCHD is both low cost and highly liquid. It manages over $72.58 billion in assets and trades 14.81 million shares every day. Its expense ratio is 0.06%, is one of the lowest in the industry, meaning you keep more of your returns. So, SCHD has proven itself over more than a decade, delivering strong long-term performance, reliable dividends, and steady growth. But like all investments, it comes with risks, and it's important to understand that dividends aren't guaranteed. Now, you might be wondering, how does SCHD manage to stay reliable for more than a decade? The secret is its built-in system for kicking out weak companies and bringing in stronger ones. So, one of the features that makes SCHD especially attractive is that it updates itself automatically. Unlike picking individual stocks where you have to constantly decide what to buy and what to sell, SCHD takes care of that process through annual rebalancing. Every March, SCHD reviews all of its holdings using strict, rules-based criteria. Companies are ranked on things like cash flow, return on equity, dividend consistency, and financial strength. If a company no longer meets the standards, it's removed. At the same time, companies that now qualify are added in. For example, back in 2023, SCHD removed companies like 3M and Walgreens. Both had declining fundamentals and concerns about whether their dividends were sustainable. In their place, SCHD added stronger players like Broadcom and Cisco, companies with healthier balance sheets and a solid history of paying and raising dividends. Same thing happened with IBM. It used to be one of the big names in the fund, but as its growth slowed, it got bumped out, and higher scoring companies like Merck and Amgen took its place. That shift also helped improve the portfolio's exposure to sectors like healthcare, which tend to be more stable over time. For investors, these changes are valuable because they keep SCHD aligned with its mission, focusing on financially healthy companies with sustainable dividends. Instead of you having to track which companies are slipping and which are improving, SCHD does the work for you. This self-correcting process is a big reason why SCHD has maintained strong results over more than a decade. It keeps the ETF focused on dividend growth while adapting to market realities year after year. But here's the catch, even with all of that, most people still won't be able to live off the income unless they really understand the math behind it. Here's where many investors run into a problem. They look at a dividend yield like SCHD's around 3.67% and think, great, I'll just put some money in and the dividends will take care of me. But when you run the numbers, reality sets in. Let's say you invest $100,000 into SCHD. At a 3.67% yield, you'll get about $3,670 a year, or roughly $305 a month. That's not even enough to cover groceries for most families. So the question becomes, how much do you really need invested for dividends to replace your salary? Here's a simple rule of thumb. For $30,000 per year in dividends, you'd need about $817,000 invested. For $50,000 per year, the target jumps to about $1.36 million. And if your goal is $70,000 a year, which is the target we're working with in this video, you'd need just over $1.9 million invested. When most people see those numbers, 800K, 1.3 million, 1.9 million, it can feel discouraging, like you're staring up at some impossible mountain and you're still standing at the bottom. That's usually the point where people start thinking, this isn't for me, and give up before they've even taken the first step. But this is where dividend growth changes the story. SCHD isn't just paying out the same amount year after year, its dividends have actually been growing at an average rate of 10.77% annually over the last decade. That means the income you're earning today could be significantly higher 5, 10, 20 years from now, even if the yield looks modest at the start. And the earlier you start reinvesting those dividends, the more powerful that growth becomes. Each reinvested dollar buys more shares, which generate more dividends, which buy more shares. And that snowball keeps rolling. Over time, it speeds up on its own, and suddenly that mountain you thought was too high starts to look a lot more manageable. So yes, the big lump sum numbers can be intimidating, but if you've got time on your side, and if you stay consistent, you don't need $1.9 million to make this work. You can start with way less and still build something meaningful. Now, you might question, what actually makes the difference? Is it the amount of money you put in, or is it the amount of time you stay invested? When it comes to dividend investing, two things matter more than anything else: how much you start with and how much time you give it. Let's look at starting amounts first. If someone invests in a large lump sum up front, the results come faster. For example, investing $500K in SCHD today would generate around $18,000 in annual dividends immediately. That's meaningful income from day one. But most people don't have $500,000 lying around, and that's where time comes in. With time, smaller contributions can still add up. Suppose someone invests just $3,000 a year, about $250 a month. After 10 years, that doesn't look huge, but stretch it out to 20 or 30 years, and the results become dramatic thanks to compounding. I'll show you in a couple of minutes. This is where the saying, time in the market beats timing the market, really shows its truth. It's not about waiting for the perfect moment to buy. It's about staying consistent and letting compounding do the heavy lifting over decades. Another way to look at it, small contributions made early often beat big contributions made late. A 25-year-old consistently investing modestly into SCHD will likely have a larger portfolio at retirement than someone who waits until 45 and tries to catch up with bigger amounts. So here's the trade-off. You can either invest more money or give your money more time. The less time you have, the more capital you'll need up front. But the more time you give it, the less you have to contribute, because compounding starts doing the heavy lifting for you. That's why we're going to look at 3 different examples, one that spans 30 years, one that runs for 20, and one that tries to make it work in just 10. Each one shows a different path to the same goal, living off your dividends. And as you'll see, the longer your timeline, the more forgiving the math becomes. So let's start with the scenario that gives you the most room to grow, the 30-year plan. This is by far the most approachable path for the average person, and it proves just how far small, consistent efforts can take you when time is on your side. This version starts with no upfront investment at all, just regular contributions of $10 a day, which works out to about $300 a month. After year 1, you would have invested $3,650. Based on the investing metrics of SCHD, by year 10, the portfolio will grow to about $67,000, and the dividends will be around $2,000 a year. At year 20, things start picking up. The portfolio will be valued at around $310,000, and the annual dividends will climb to about $14,000. And then comes the breakthrough decade. By year 30, the portfolio will grow to about $1.3 million, paying an annual dividend income of $75,000, which is about $6,250 per month, meeting our goal. Now, let's say you've got 20 years to work with. You've still got time on your side, just not as much, so the strategy adjusts. In this case, the plan starts with a $65,000 upfront investment, and you add about $760 a month, or $25 a day. With this investment, in year 1, the total portfolio sits at around $82,000, generating a little over $2,300 in dividends. By year 10, the portfolio will go up to $383,000, and the dividends will be around $15,000 a year, enough to cover food, utilities, or a portion of rent or a mortgage. Fast forward to year 20, and things really come together. The the portfolio reaches about $1.55 million, and annual dividend income rises to around $73,000, which is over $6,000 in monthly dividend income, more than the median US household income, earned passively and without ever touching the principal. Finally, let's look at the Fast Track plan, just 10 years. This is the most aggressive version, and to make it work, you'll need serious capital right from the start. In this case, the plan begins with $500,000 up front, plus $915 a month, or $30 a day, in additional contributions. In the very first year, the portfolio will be worth about $572,800, generating roughly $18,350 in dividends. By year 5, the portfolio will be $972,000, and the dividend income will be up to around $34,000 a year, which, for many, is like adding a second paycheck. And by year 10, the portfolio will be valued at around $1.86 million, with annual dividends topping $72,000, exactly $6,000 a month in dividend income. Of course, this version of the plan takes a big head start. Not everyone will begin with that much capital, and that's completely fine, because as we've seen, if you don't have the money, time can make up for it. Want to know how much you'd need to invest in index funds to make $28,000 a month? Click the video on screen to find out.